Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 7th, 2025. I am Luna.
I am JPMorgan. So Wall Street finished higher today. Pretty strong tech surge leading the way. The S&P 500, it was up about 0.7%, and the Nasdaq composite gained a solid 1.2%. And Apple was a big story, right? Jumped around 5%.
Yeah, that was on the back of their big $100 billion U.S. manufacturing investment news. Really gave it a boost.
And pulled others like Amazon and Tesla up that looks like around 4% gains there too.
Exactly. But, while big tech looks strong overall, if you dig into individual earnings, it was actually kind of a mixed picture.
Oh, really? How so?
Well, you had Shopify just soaring, up 22% after really strong numbers. Great result for them.
Wow, 22%?
Yeah. But then on the other side, you had Disney. Their shares fell almost 3% because they missed on revenue forecasts. So not all good news.
Interesting spread. And outside of stocks, what else caught your eye?
Well, we saw the 10-year Treasury yield tick up a bit. Gold nudged higher, too. Bitcoin seemed to find its footing again. And oil prices bounced back, actually. Snapped a 5-day losing streak there.
Okay, so tech lifts the averages, but earnings are a bit all over the place. What's the bigger narrative here? What's really giving the market this lift? Sounds like maybe the Fed is playing a big role.
I think that's a huge part of it, yeah. There's been a pretty distinct dovish turn from some Fed officials just in the last day or so.
Dovish turn? Okay. Like who?
We heard from Neil Kashkari at the Minneapolis Fed and Mary Daly over in San Francisco. Both basically said something like 2 quarter-point rate cuts by the end of the year seems, well, reasonable or likely appropriate.
And why now? What are they seeing?
They're pointing to the economy clearly slowing down and, crucially, the labor market cooling off. These comments, well, they've definitely boosted hopes for a rate cut maybe as soon as September. That's adding fuel to the fire,
Right, so Fed talk is boosting sentiment. But didn't the bond market throw a bit of a wrench in the works? I heard something about a Treasury auction.
Ah, yes. Good point. Just as the Fed seemed to be calming nerves, we got a really disappointing auction for 10-year Treasury notes.
Disappointing how? Low demand.
Exactly. Demand was weak. The yield it sold at, 4.255%, was actually a bit higher than where the market was trading just before that's what they call a tail. Not a good sign. And the bid-to-cover ratio, which measures demand strength, was low too, only 2.35. Some analysts literally gave the option a D's grade.
Ouch, a D's grade.
Yeah. And foreign buyers weren't particularly interested, it seems, which left the primary dealers holding more of the bonds than usual.
So what's the message there? Investors getting nervous about U.S. debt levels?
It certainly suggests some caution, yeah. They seem to be demanding a higher return to absorb all this new debt, and that pushed the 10-year yield back up, snapping, I think, 4 days of declines. Kind of works against that Fed dovishness a bit.
Okay, so Fed-leaning dovish based on a cooling economy, especially the labor market. Let's touch on that. What are the latest job numbers telling us? Are they really weak enough to justify cuts soon?
Well, the latest weekly numbers for initial jobless claims did tick up slightly, came in at 221,000.
Is that high? Low?
It was just a little bit above what forecasts expected. Not a huge jump, but it does add to the picture of, other softening labor market indicators we've seen. So, yeah, it kind of reinforces the Fed's thinking. Even though it was just a modest increase, it's another small piece suggesting things are loosening up.
Got it. Okay, looking forward then. What data points are really critical for you, the ones that could potentially shift this whole outlook?
The big one definitely is the July Consumer Price Index, the CPI report. That's due out August 12th.
Right, inflation. What are the expectations there?
The consensus seems to be for core inflation, so stripping out food and energy, to have risen about 0.3% in July. That would push the year-over-year CPI number up towards maybe 3.0%.
And it comes in hotter than that.
Well, any surprise, especially an upside one, could really make the Fed rethink things. It could potentially dampen those rate cut expectations pretty quickly.
Makes sense. Anything else besides CPI?
Yeah, we also get the Producer Price Index, the PPI the day after CPI, and then later that week, the first look at August consumer sentiment. Both worth watching.
Okay, so let's try and tie this all together. You mentioned this idea of a fragile equilibrium earlier. Can you expand on that? What are the main fault lines here?
Yeah, fragile equilibrium feels about right. On one hand, you've got this sort of tailwind from expected Fed cuts, which is supporting the market. But it feels like it's balanced on a nice edge, really. The big risks, I'd say. First, those bond market issues we talked about.
A weak auction.
Right. It shows investors might demand higher yields for all this U.S. debt. That can tighten financial conditions, even if the Fed cuts, and put pressure on especially those high-flying tech stocks.
Okay, risk one, Bond market constraints. What else?
Second is inflation uncertainty. We just talked about CPI, but also think about new tariffs. There's talk of an extra 25% on imports from India, maybe new ones on China down the line.
And tariffs push prices up.
Usually, yes. Which could make inflation stickier and, again, give the Fed less room or less reason to cut rates as much as the market hopes.
Makes sense. Any other major risks?
Well, there's always geopolitics, isn't there? You know, headlines about President Trump possibly meeting with Russia's President Putin. Things like that can swing market sentiment pretty fast, often unpredictably. It's a wild card.
So, bond market pressures, inflation risks from things like tariffs and geopolitics. It really does sound like a fragile equilibrium. That seems to be the core takeaway here.
I think so. Cautious optimism maybe, but definitely balanced by these very significant risks lurking beneath the surface.
So, final thought for our listeners.
Given all these cross-currents we've discussed, maybe ask yourself, why is really understanding the demand for U.S. government debt and thinking about how new tariffs might affect inflation so critical for your own financial planning in the next few months? It really highlights that, staying vigilant and ensuring you're diversified, that remains absolutely key in this kind of dynamic and, frankly, uncertain environment. Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.